Day trading is not hard, but you really need to know this. In this video, we dive deep into the mindset and strategies that transformed my trading journey from impulsiveness to informed decision making. Through years of experience, I've learned that understanding market dynamics, trader psychology, and a disciplined approach are key to successful day trading. Day trading involves buying and selling financial instruments within the same trading day. While it may seem straightforward, the complexity lies in the myriad of factors influencing market movements. Success in day trading requires more than just reacting to price changes. It's about a comprehensive strategy that includes understanding trends, risk management, and anticipating other traders' moves. The transformation in day trading comes from recognizing three crucial concepts: the importance of multiple conditions for entering trades, the significance of the larger market trend, and the necessity to think like both a bull and a bear trader. It's not just about seeing a price drop and deciding to short. It's about a layered analysis that informs each trade. You need to really watch the larger trend. Always consider the overarching trend of the market or the specific stock you're trading. A single resistance point is not enough to base your entire trade on. Also, take into consideration multiple conditions for entry. Develop a checklist of conditions that must be met before you enter a trade. This might include technical indicators, market news, or specific price movements. My checklist includes low float stocks. Now, a lot of people have different criteria for what is low float. In day trading, most days what we're looking at is stocks with less than 10 million shares in the float. Now, when I say that, you might be like, what is it? Why does it matter? Remember, when we think of float are the freely tradable shares. That is the supply, okay? And one of the reasons we care so much about low float stocks is, remember, when you had your high school economics class, hopefully you had one, hopefully you didn't flunk out of it. I think I probably did. But anyway, remember, what was all the entire economics class? Like, what did it all boil down to? Supply and demand, right? I mean, there's a lot of stuff you went over. It's a year-long class. Maybe you had multiple economics classes. But in capitalism, at the end of the day, it's all supply and demand. What makes a price go up? Low supply, high demand. What makes a price go down? High supply and low demand. I mean, it could be oil, it could be orange juice, it could be gold, it could be stocks, okay? So the reason we care about low float is the smaller the supply, the better the potential for explosive moves to upside or even the downside. I mean, that's what's great about these low float stocks is they're very, very tradable on the long and the short side. So the smaller the float, the better. That's the next question I get is like, I always say less than 10 million shares in the float is considered low float, but people ask, what's the best? Like, listen, I remember many stocks that have gone like from $2 to literally $50 in one day, and most of them were less than $1 million in the float. So lower the float, the better potential for explosive moves, especially when we see massive, unusual demand. Okay, we're going to talk about that here in a second. So now, next thing people ask is, well, does that mean you never trade stocks with higher than a 10 million float? No, that's not true. But this is the one thing that a lot of people overlook, is if it is 100 million float or $1 billion in the float. I mean, remember, a lot of like real stocks like Apple and Microsoft, they've got billions and billions of shares in the float. If you have those bigger floats, you just have to have realistic expectations. You can't expect Apple to go up 100% in a day, right? I mean, you've probably seen Apple move huge when they release a new iPhone or a new product or whatever it is, and it's like 2 or 3%. Great move, but that's what trips up a lot of people. They see these 100 million, 500 million float stocks up 20%, and they're like, why isn't it going any higher? So lower the float, the better. Always, 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 especially if you're with a small account looking to grow it rapidly, less than 10 million, and the lower the float, the better. Next, the price is up more than 10%, or even these days, 20% or more. Really, the biggest thing is look for the biggest percent gainers every single day. And don't ever, ever, ever even waste your time looking at the financials or looking at the news or looking at anything on a stock that's not up at least 10 to 20%. You're wasting your time because, listen, the demand's not there, okay? If the demand was there, the stock would be up 50, 60, 70, 80%. Now, one thing that trips up a lot of newer traders is they think if these stocks are up that big, they can't go higher. Listen, I've been doing this for 18 years, okay? We've seen stocks as recently as last week that went from $2 to $100 in a couple days, okay? So don't focus on stocks that are barely moving. If the market cares, if the potential is there, it will be up huge. Don't look at small percent gainers. Start with the biggest percent gainer, look at your float, and then look at the next criteria, unusual volume. And I know I'm harping on this, but it cracks me, or doesn't crack me up, kind of bums me out when people don't understand the simple supply and demand dynamics of trading stocks. And when we look at unusual volume, the main criteria I use is the 60-day moving average. If you've got StocksToTrade, it's built right into the main screen. You can always tweak that. That's what I see as the best indicator. And most of these stocks you'll see might have 1 million shares traded a day, maybe 500,000, sometimes even less. What we're looking for is massive, massive increases in volume. So if this stock is normally trading 1 million shares a day, we want to see 10, 20, 50, 100 million shares traded a day. Again, supply and demand. If there's limited supply, low float, and there's float rotation, then that gives us a massive potential for explosive moves higher. And when we think of float rotation, that's just the amount of volume churning through the float. So we got a 10 million float stock, trading 100 million shares on the day, 10x float rotation should always be at the top of your list. Unusual volume, absolutely critical, okay? Avoid low volume stocks, avoid average volume stocks like the absolute plague. And the biggest reason is you'll get in these stocks, maybe it's up big, maybe it has a catalyst, but if there's not unusual volume, you're just gonna get bored to death and tying up your buying power. And remember, 90% of you watching this video have a small account. Your trading capital is your ammunition. Okay, you can't be locking up your ammunition where it's not accessible. You need to be in and out, very agile, so that you're not locking up your buying power in sideways stocks. Next, former runner, okay? This is actually kind of simple. A lot of people way overcomplicate this. And we use 3 time frames in trading, okay? The 1 year, 1 day chart, so a 1 year time frame with 1 day candles, a 2 month, 15-minute chart. That's why we like that 2 minute period that ties back to the 60-day average volume, not a coincidence. So 2 month and 15-minute candles. And then I highly recommend all of you new traders to use 5-minute candles intraday. I know 1 minutes are tempting, use 5. So the 1 day, 5 minute. So back to former runner, just look at the 1 year, 1 day chart, okay? Did this stock have a history of big spikes in the past? If it hasn't spiked big in the last year, odds are it's not going to. It could have all these other criteria, but if there's no past history of big runs, it's probably not going to run again. Now, people get all FOMO'd up and they want to catch the day one move. Listen, if it's a day oneer, that's what we call these stocks that have no history of running, and it survives into the end of the day, closes at or around the high, then it becomes your number one for the next day. But guess what? It's now a former runner, okay? Because it held its gains all of day one. You can see that on the 1 day or the 1 year, 1 day chart. Next is catalyst, okay? You have to have a why. And this is one of the biggest ones where I will battle with some newer traders. Like, I think they see the logic in all the other ones. People love to trade stocks with no why for the move, and I don't understand it. Like, every day we've got 10 stocks that are in the hot sector. They have news, they have a contract win, they got a new product. Like, literally every day there's 10 stocks with a catalyst, and people still obsess over trading stocks with no reason for the move, and then they can't figure out why the breakout always fails. And I'm like, yeah, there's no reason for people to get excited about this. You probably bought a chat pump, guess what, okay? Or a Twitter pump, or some stock that was a pump and dump with nothing behind it, and that's why you keep getting bagged trading breakouts, okay? It is so simple. It'd be different if we didn't have 10 a day, okay? There was like 1 stock a day with a catalyst, different story, okay? We have 10 a day with news, substantial news. Those always move to the top of the list. Last and most important area, and we'll get into technical analysis a lot more in other videos. For the sake of time, I mean, technical analysis takes more than a 10-minute video to teach you, but what we're looking for is an area to set our risk at, okay? A previous breakout level that the stock can pull back to and bounce off of. Then if it pulls back to that level and fails, it's a failed breakout and we move on to the next trade. So my friends, those are the most important criteria to look at every single trade. And one thing you always have to do is to think like your opponent. Understand the motivations and likely actions of traders on the opposite side of your position. If you're considering a long position, think about where the bears might be taking profits and vice versa. Prepare for all outcomes. Always have a plan for both if the trade goes in your favor and if it doesn't. This includes setting clear stop loss and taking profit levels. Always be continuously learning and adapting. The market is always changing, so you should change your strategies. Stay informed about market conditions, economic news, and any other factors that can impact your trades. Day trading is not hard, but you can make it really hard if you're not disciplined, okay? It requires a strategic mindset. More than anything, it requires discipline and an ongoing commitment to learning. By understanding the market from multiple angles and preparing for various outcomes, you can navigate the complexities of day trading with confidence. Remember, successful trading isn't about making the perfect trade every time. It's about having a solid strategy, managing your risk, and maintaining the discipline to stick to your trading plan. And I tell you, every single trading day, we go over these concepts in what's called the Daily Income Trader system. This is a system that we developed over the last 8 years to use an algorithm, the best stock scans, chart history, chart patterns, every single trading day. And the best way to learn every single one of these concepts that I went over is to click a link below and join a free webinar where we give you a hands-on tour of the system. 100% free, multiple times a day, all the way up until 9 p.m. at night and even on weekends. So I think I packed a ton of information in this short video. So if you're like, wow, and there's some other questions I have, these webinars are 100% live and interactive. So hit that link below and we'll see you on the next webinar.